This week, should the HECM's upfront mortgage insurance premium structure be reduced? What are the potential risks and benefits? More on that in a moment. Welcome back to the Industry Leader Update. There has been much discussion recently on the Federal Housing Finance Authority's recent changes to what we call loan level pricing adjustments. But we can also say, what about the HECM's upfront fee structure? And we are going to get to that, but before we do, let's talk about the recent loan level pricing adjustment controversy we've seen in the media.
Starting in May, a new federal rule will subject home buyers with good credit scores to higher mortgage fees, while riskier buyers will get more favorable mortgage terms. This is part of an effort to try and get more first-time and low-income buyers into the world of home ownership.
The mortgage report defines a loan level pricing adjustment as a risk-based fee which is assessed to mortgage borrowers that are using a conventional mortgage loan. And those loan level pricing adjustments are going to vary by borrower based on the loan traits such as loan to value, the borrower's credit score, the loan's purpose, occupancy, and the number of units involved in the transaction. Now, borrowers will often pay an adjustment in the form of a slightly higher mortgage rate. But truth be told, if one examines the specific bands of the new pricing structure, an argument can be made either way. The loan level pricing controversy, however, does bring to mind one of the major challenges to the expansion of the HECM's market acceptance, and that is our current fee structure, more specifically the FHA mortgage insurance premiums paid up front by borrowers, regardless of any factors that may mitigate the risk of a claim being paid in the future. Now, one of the biggest obstacles we hear from consumer groups and the homeowner is the upfront cost, and much of that can be attributed to the upfront mortgage insurance premium, which, by the way, at today's HECM limit of $1,089,000 would be a total staggering $21,700. So would a reduction of that fee bring more borrowers into the HECM program? And would an influx of new borrowers paying ongoing insurance for many years actually help increase FHA's loan revenues? Now, to answer that question, we reached out to Dan Hultquist of Understanding Reverse, who I consider one of our industry's foremost experts on all things reverse mortgage. And I asked him, is a reduction of the initial MIP warranted? Absolutely, says Hultquist. The IMIP charge is still a stumbling block for almost all reverse mortgage prospects, and anyone that has sold a HECM for any length of time knows that our two primary roadblocks are cost and public perception. Sadly, he says, the former intensifies the problem with the latter. Now, the 2% upfront premium charge has been part of the HECM handbook for nearly 30 years, says Hultquist. Can you believe that? Yet that fee remains in place despite a borrower seeing their loan proceeds reduced by principal limit factor reductions. By 2009, borrowers could access 62 to 90% of their home's value on day one, depending on their age. Today, borrowers may have principal limits as low as 30%. In addition, borrowers who started the process with a free and clear home are restricted to 60% of that calculated amount. This means many borrowers may only have access to 18% of their home's value in the first year, and yet they still pay the same percentage up front. Now, wouldn't reducing the upfront insurance premium actually hurt FHA's Mutual Mortgage Insurance Fund? Hultquist contends that a reduction in the HECM upfront insurance premium actually would increase HECM loan volumes and help more homeowners age in place, but at the same time, by removing the price objection that continues to stymie HECM endorsement growth. But that increase in loan volume and endorsements would ultimately increase the fees that FHA collects from HECM borrowers. However, Hultquist does note that the churning or refinance of existing HECMs is undermining the performance of the HECM portion of the MMIP, and that the refinance structure and the insurance premiums for those transactions need to be relooked. But this topic warrants an expanded discussion, and we hope to have Dan back here shortly for a full interview in the coming weeks. But in the meantime, if you'd leave your comments, do you believe that there is a need to reduce the upfront 2% mortgage insurance premium for HECM loans? Yes or no? And also, what do you see as the risks to the program and the benefits to the program being? We want to hear what you have to say. And if you'd be so kind as to share today's video on your LinkedIn and Facebook profiles, we do appreciate that. And don't forget, we have a YouTube channel where you can subscribe and hit that like button if you appreciate the content we put together for you each week. And speaking of each week, we have reverse mortgage news on our weekly podcast, HECM World Weekly. Apple users can listen and subscribe on iTunes. That's a wrap for us this week, and be sure to return next Monday for more reverse mortgage news, commentary, and analysis here at HECM World.